And welcome back again. In today's session, we're going to look at the second in our two-part video of alternative investments. In the earlier part, we had a look at alternative investments like private equity, real estate. Today's session, we're going to focus more on commodities, hedge funds, and other types of investment strategies. In the section we're going to take a look at today, we'll start off by looking at commodities. And I think most people have, over the course of this program, had an opportunity to take a look, at least in a cursory way, at commodities. Everybody knows a little bit about commodities like gold and silver. Other commodities become particularly important depending on the industries that you might be associated with. For example, if you're involved in transportation, things like jet fuel or oil may be a major part of your business, a major cost, and finding a way to hedge that commodity risk may be a very important part of what you do. For everybody who wants to hedge, there has to be a counterparty. There has to be somebody on the other side of the deal, an investor who's willing to take a long or short position to match yours. Because as I'll mention later, commodities are a zero-sum game. Whenever one side gains, the other side has to give up. And if you're managing an investment portfolio, one of the categories, one of the classes of assets that are often underrepresented are those commodities. Now, we can invest in a couple of different ways in commodities. One is directly through actually purchasing the physical commodities. And that makes a certain amount of sense if we're talking about things that are easily stored and easily transported. Things like gold or diamonds, silver, platinum, things that you can keep in your vault. Probably a lot less so if we're talking about commodities like pork bellies or corn or oil, natural gas. So it can involve the physical purchase or the purchase of a physical commodity, things like agricultural products, metals, oil, and so on. It may be possible also to get exposure to those particular commodities through derivative markets by using things like futures contracts. In many cases, we have to be aware of the costs of physical stewardship of an asset, because if we do actually hold on to it, we have to be able to pay the storage costs, the transportation, the security costs, the insurance, and so on. Indirect investment in commodities is also possible by taking a stake in the equity of the commodity producers. So I could buy gold or gold certificates, which would be a type of direct investment, or I could buy shares in a gold mining firm which actually held large inventories of gold. Be careful when you check those indirect investments, because quite often companies who produce gold will also hedge, and they may actually have very little exposure to gold prices, even though they're a gold mining firm, because they've hedged away some of their own gold exposure. It doesn't provide full exposure to commodity price movements because, as I mentioned, companies may hedge their own exposure. A famous example of this, a Canadian-based company that operates in Africa called Ashanti Gold. Its share price rose significantly because people saw the price of gold was going up and said, wow, let's just buy these shares in a gold mining firm. It's a lot easier than taking direct stake in gold. The next quarterly announcement, Ashanti said, well, yes, the price of gold has gone up, but we hedged 120% of our exposure. So when the price of gold went up, the price of Ashanti and the value of the firm actually should have fallen. And as a result, the share price fell by a lot. And most people in the mining industry learned that market risk is something that we like to buy into. We want our gold companies to have exposure to gold. You can see examples of commodity markets at work just by looking out of your window if you live in a place like Vancouver, because we have all of these massive oil tankers that are sitting, apparently doing nothing, in English Bay right in front of Vancouver. And people will from time to time wonder why those tankers aren't moving, why they aren't unloading, why they aren't moving off to another port. Well, part of the answer is the commodity business. That is essentially floating storage. And at a time when the markets are particularly bad, as they have been recently, those tankers are sitting there because they have no place to go because nobody wants or needs the oil. And the easiest place to store that material is sitting in front of all those very expensive apartments in Vancouver. We'll talk a little bit about that in just a couple of minutes. To be able to understand how commodity markets work, we can track those markets using benchmarks. For example, Goldman Sachs manages a couple of quite well-known commodity benchmarks. Essentially, they're an index that is based principally on futures prices, and it'll try to track or to replicate the returns available to holding a long position or to holding a buying position in those commodities. The indices can vary in their composition, the weighting scheme, and their purpose according to the nature of the people that need those indices. You can't actually do the market weighting. It is essentially, the weighting that we do use is arbitrary, or it's based on world production levels. And we can base this on the total return, and we'll talk about the components of return in just a couple of seconds, or the spot price. The type of returns that we get come in three categories. We have the return that we get from movement in the spot price. So a change in the spot price during the contract can be the largest single source of return from the contract. If we bought gold at 1800 and it went up to 1900 the next day, that would be the change in the spot price. The second type of return is the one that we come from basically the return to a risk-free instrument, the treasury yield, if we're taking the rest of our money that we're not using for the margin and investing that in a risk-free investment. That's called the collateral return or the collateral yield. Remember, if you want to buy a contract, a futures contract, you don't put up the full nominal value of the contract. You only put up a margin according to the contract terms. So the money that you're not actually using for margin is investable elsewhere. And the best proxy for that return is a risk-free rate of return. The third type of return is the return we get from having successive contracts, and we call that the roll return or the roll yield. It assumes we're going to continue to carry on renewing contracts as they expire for the foreseeable future. It arrives from rolling contracts forward, from buying successive contracts as the spots and the futures prices move towards, convergence. In other words, the forward price today will eventually, when the contract completes, reach its spot price at which we can buy the spot asset. There are a couple of different ways of looking at this, a couple of different profiles for these kind of investments, and they've got wonderful names that your spelling checker will definitely not like. One of them is called backwardation or normal backwardation, which essentially says there's a downward sloping term structure means that we'll have positive roll yield. Essentially that means that the futures price will rise to meet the spot price over time. And so we're going to, if we hold on to that contract, eventually realize the full spot price, even though we bought the forward contract or the futures contract at a discount. An upward sloping structure is one where the longer we hold on to the contract, the lower the spot price is going to be. In other words, if we expect to see the prices, the prices of the underlying asset continue to fall. And this is essentially what we mean. Normal backwardation is normally the most common profile. And the longer we hold on to a forward contract, eventually it will converge to the expected spot price. So we're going to be buying it at a discount to the expected spot price. So if we bought it in January and we closed it in July, over time, even moving through successive contracts, the forward price would rise to eventually meet the spot price. Much less usual is the contango position, where we see that the world price for an asset today might be significantly undervalued, and we're hoping that the price is going to rise in the future. So we buy at a premium and we hold on to it, and we expect to see that it's going to eventually converge. The simplest example of contango is what we see today when we have, especially a couple of months ago, when we have a glut of oil worldwide, and those tankers start to accumulate outside of major ports, filled with oil with no place to go. Whenever the world economy slows down, we have certain types of assets which are very difficult and expensive to store. Among those, natural gas and oil are probably the two most extreme examples. That's one of the reasons why the price at the pumps fell so much during the pandemic recently, was because the system was backed up. There was so much fuel being stored in the system, and there was also fuel coming out of the ground, or oil coming out of the ground and out of refineries, and it just had no place to go. So during 2009, 2008, 2009, when we had the financial crisis, recently with the pandemic, the price of oil fell, and typically, as it does, from a higher price to a lower price as there's less demand for the oil. And in our most recent case, while producers like Saudi Arabia and Russia continued to produce at high levels, so we ended up with a worldwide glut of oil. And that becomes a condition that we describe as contango, with a very low price in the spot market and a much higher price in the forward market, because people figure the price has got to rise in the future. That's why the contango line is above the expected spot price. Now, if I want to know more about futures contracts, there are several resources that I can use. You'll see in our stock track game that we do have a few futures contracts that are available. If you want to know more about futures contracts, the best place to look is the Chicago Mercantile Exchange's Globex trading platform. And here we can see, for example, for gold, with a spot price today of about $1,800 and something per ounce, you can see that there are contracts available for August, September, October, December, and so on, well into the future. And that these prices are rising into the future. So the expected spot rate for August, for September, shows an upward slope. And that kind of matches our recent history of rapidly rising gold prices. If I want information, you can see across this line I have information about the opening, the high, and the low price during the day. I also have a very important number here. I've got my volume number. That shows me the number of contracts that were traded. Not the number of ounces, but the number of contracts. And there are a certain number of ounces, in the case of gold, in a contract. So I would have to look and get the information by looking at the contract specification at Globex. There is also information about the final price, or the settlement price, which is a little bit different than the single last contract that was sold, because people have been known to try to game futures prices by putting in a silly high purchase price on the last trade of the day. That means that people would expect it to also open higher the next day. So settlement price is actually an average of the last trades of the day, perhaps the last 10 or the last 20 trades during the trading period. So that information is available for each period. You'll also see that we've got a couple of other hyperlinks that we can click on. One is for options and another is for charts. If I click on the options tab, you'll see that it actually takes me to a futures options price for each of these commodities. Here we're still looking at gold. We're looking at the futures contract for an August 2020 futures contract. So that becomes the underlying price. For futures contract, the underlying price is the spot market in gold. For options, the underlying price is the futures contract. So this is an option on a futures. That's where we get the name. And you can see the different prices that are available. We could have a strike price or an option price of $1,800, a little bit less. $1,800 is pretty close to at the money. $1,805, $1,810, and so on. These are also at the money. And then we have some out of the money or much higher priced contracts that go up to $1,830. And we have some in the money contracts like this one, $1,795, and I guess $1,800 is as well. On the left hand side we have call options that are available, and we have put options as well. So you can essentially take long and short positions in these options. Now the advantage here to having options based on futures versus options based on the spot market is that all of the futures trading happens in an open forum, where spot exchange happens partly in an open market but also happens off the market. So we know that the underlying price is going to be more reliable. So in a strange sort of way, a derivative becomes more reliable as a measure than the underlying asset. So that's going to be one of our main sources. Of course, Globex isn't the only commodity exchange, but it is certainly the best known and the most liquid. Some of the basic characteristics of commodity investments, well, it's an advantage to hold this in our portfolio because it has a low correlation with our other principal assets, our other stocks and bonds. It tends to rise, or commodities tend to rise in times of economic distress, and it provides us with extra diversification. So when stocks and bonds are doing badly, quite often commodities are doing well, because people are nervous about holding pieces of paper. They'd rather have the sense that they hold something physical, but also because commodities tend to be a good hedge. Not all, but some tend to be a good hedge against inflation. Some of the determinants of return include sensitivity of that asset to a business cycle. For example, gold and platinum and silver. Convenience yield. Sometimes it's just something that you're going to need to buy in the future, and it's part of a hedging program that will allow you to control your own costs. For example, if you need a material like silver in order to produce your product, you can use futures contracts to hedge against the rising price of silver by taking short position in silver and having if you have a long position in futures contracts to meet your short position in physical silver, you're actually hedging so that if the price of silver goes up, you will make money in the futures contracts, but you'll lose it by having to buy that silver to complete your production process. It also may include options that are like real options, and they may be options to increase or reduce your production based on having protected those prices. And they can be, as I mentioned earlier, hedge against inflation. The value of the asset doesn't increase, but the value of the currency decreases. Commodities are in the portfolio typically as a risk diversifier. They have typically lower returns than stocks and bonds, but they have very low and quite often negative correlations with bonds and stocks, and a good hedge against inflation. Now, that's a really quick introduction to commodities. This is really something that we would study as a completely separate topic. And we will perhaps mention this a little bit more when we talk about derivatives a little bit later on in the course. Another class of alternative investment that's become quite famous, and the one area that perhaps the hedge fund managers have become like the rock stars in finance. Perhaps there's a lot more myth and a lot more hype about hedge funds than there is reality and real performance, as is brought forward by this kind of risque cover from Bloomberg. Hedge fund managers, as I mentioned earlier, tend to become the rock stars of finance, not because of performance, because of their ability to self-promote. And that's because the type of investors who invest in hedge funds tend to be the ones with very large amounts of money, very large amounts of capital. Essentially, a hedge fund is like a mutual fund, but for qualified investors. And by qualified, essentially the rules say that you have to be considered a sophisticated investor. And that starts off with having a large amount of capital to invest. The basic rule says you have to have $1 million to invest in that class of assets, but most hedge funds require much higher buy-in values than that. Hedge funds have evolved to take on a lot of different meaning. The original hedge fund was essentially just a hedged fund. In other words, for every investment that was made, every investment that we were long in, we would have some kind of an offsetting derivative product. So if the price went up, we gained from the improvement in the underlying asset, and we lost a little bit because we had to walk away from that derivative contract. But if the price went down, well, our underlying asset fell, but our derivative asset went up. The net result in an original hedged fund was that you would make the risk-free rate of return plus a little bit extra. And by using some leverage, you could take that little bit extra and make it a lot extra. That was the original hedge fund. That was how they were designed. And you could only make a hedge fund work if you had a lot of capital available to invest at short notice. And so that's how the industry really started. Some of the types of hedge funds that we see today can be described, well, we have a couple of long lists that I won't go through in a lot of detail. Market neutral, we have long position in stocks and short positions, either in stocks but also in derivatives, to eliminate systematic exposure and create a neutral beta. We can have a convertible arbitrage, trying to take advantage of the difference between stock prices and other convertible instruments. Fixed income arbitrage, trying to do the same thing essentially with bonds, especially by doing things like predicting differences in the time structure and or credit ratings. We can also have hedge funds that invest in distressed securities, stocks or bonds, which may be issued by, or may have issuers who are typically at risk of bankruptcy. Again, continuing the same list, merger arbitrage, trying to deal with the difference between the offered price for a company that's about to be acquired and the current price, essentially assuming that that price will eventually converge to the closing date, or the merger will fall apart. We can have 100% equity, a hedged equity position, long and short positions in a particular stock. We can have a geographically diversified hedge fund, a global macro, one that focuses on emerging markets, or we can just have a hedge fund that invests in hedge funds, a fund of funds. Now, this list is not exhaustive, although reading it out is. It's essentially it is essentially a general feel for the way that hedge funds may work, and a hedge fund's nature may change over time as the fund manager changes strategy. There are a number of style classifications, as we have with mutual funds. We could say one that is value-driven, event-driven, one that is meant to hedge equity, to allocate assets, or to take extensive short positions. And those may be the type of classifications that we use to compare and to create benchmarks. The structure of a fund is a lot like the private equity that we discussed in the earlier session. Compensation to the fund manager is based on a fee for the total amount under management. So there's a real incentive to increase the size of the fund. That can be 1.5% or 2%. And then there's going to be, like a carried interest, there's going to be an incentive fee that will be 15 or 20% above a benchmark rate of return. So if we set our benchmark at 5% and we make 20%, then the hedge fund management firm would be in a position to collect the difference, say the 15% difference. They would get 20% of that 15% of performance above the benchmark. There may also be a clause that says that if the price goes up and the price goes down, you can only capture your bonus once. So if you have a volatile fund, you're not going to get paid more by churning the investment. There is a lot of criticism of the high fees that are charged by hedge funds. Essentially, all they're doing, in many cases, is just providing exposure that any individual investor could have bought into themselves by observing the beta. So it's just a fair rate of return for risk. Quite often, the money is locked in for a very long period of time, so there's an illiquidity with hedge fund investments. You perhaps have to invest for a period of years. Benchmarks are both hard to find, they're expensive to use, and they can also be quite inaccurate. So it is difficult to actually say whether a hedge fund manager is doing well, at least in the near term. They can be based on monthly reports of data or daily reports, whether or not the funds allow subsequent investment or whether or not they're closed, and they might actually provide a list of the funds that have been used. Some of the differences that are used by benchmark, the difference in the nature of the components or the participants in the fund, the selection criteria, whether or not the funds that are reported are within a certain style classification, whether their values are based on a simple price weighting equal weighting, or market capitalization, asset weighting. How often the hedge fund index is rebalanced, and whether or not it's possible to actually buy all of the funds in the investment, the investability. There are many limitations and many problems, and we have to be aware of those when we listen to companies tell us that they outperformed an index, because quite often those claims are misleading. Hedge funds are all about providing an absolute return. That means there's no direct way of determining their performance, as we have with stocks, where you can simply compare them to a total return index like the Standard & Poor's 500 or a price index. But in order to calculate things like our Sharpe ratio, we need to have a way of calculating the alpha. So if we know what the benchmark rate of return was, and we know what the company's return was, we want to know about alpha. Is the alpha generated going to be a general alpha against all investments, or is it going to be related to a specific benchmark that we can test? Does it take into account all of these systematic risks that are faced by that portfolio? Most of the sources of information about hedge funds, most of the databases, allow the actual fund managers to tell us how well they're doing. We can't actually audit the results that are given to us. We have to assume that those firms are telling us the truth. We also may be given information from the last period, or from the last period about investments that were realized a couple periods before that. So the data that's in our self-reported information might also be significantly out of date. We also have the possibility that good results from previous periods are selectively reported. So we had perhaps we thought we were losing money on an investment, and we didn't report it last period, but it turned out okay, so we're going to report that one. And that's a kind of a selection bias, and also a bit of a survivorship bias. So any fund manager who's bringing in information from previous periods can do that if it will make them look good. And so on average, we'd expect all of our investments to be above average, and that's just not right. Some of the basic characteristics then of hedge funds. Essentially, we describe a hedge fund as a trading strategy that helps to explain those returns. The returns outperform the Standard & Poor's index, let's say. Well, the reason for that would be the following. We followed this particular trading approach, this hedged approach, and so on. If the hedge fund is following a market neutral strategy, if it's not got a particular bias in favor of the market changing, then it may actually provide more diversification value in our portfolio. When we talked earlier about stocks meeting the mean variance optimization approach, where we can choose a portfolio that somehow fit on our efficient market, within the efficient market hypothesis, or on the efficient frontier, that tended to work relatively well for stocks, but it doesn't work so well for hedge fund. That's because it's not just about mean and variance. There's a degree of optionality that's built into hedge funds because of the use of derivatives, if for no other reason. And that means that we expect a normal type of a profile for a hedge fund to be skewed. And we may also expect, partly because of stale date reporting, there to be a lot of extreme positive values. And that also leads to kurtosis, or fat tails. The approach of investors when they're looking at a hedge fund, our due diligence process, well, it's difficult to do that because the information is not transparent. There's always going to be a certain amount of proprietary information within hedge funds about the way that they operate. And they say that if they disclose that information, their trading strategy would not work. Everybody would copy it, and that arbitrage opportunity could disappear. And some of the things that we could actually look into include things like, well, who are the people? How is it legally structured? Have they got a defined strategy that they're publishing? How about performance data? Is that available? What kind of measurable risks have we got, and can we predict those risks? Do they disclose the research that they provided on their own fund's performance? Have they got stable and credible administration? Are there important legal conditions built into the hedge funds, like lock-in periods? Are there other references that they can provide? So those are some of the things that we'd look at to try to understand the quality of the hedge fund. Some of the concerns that we have about performance in hedge funds include that some of the issues about returns and how they're reported. Monthly returns are compounded within the annualized rate of return, and the actual reconstitution of the fund might change more frequently. Adding stocks and taking away stocks might happen on a month-to-month basis, not on a quarterly basis. So the performance might actually be reporting companies that are no longer held within the portfolio. And if we are drawing down or reducing funds from the portfolio, that compounding value is no longer available. So we're going to have a smaller fund which is capable of producing only a smaller return in the future, so the historical results are not going to be so relevant. We also have got a lot of leverage that's built into several of the strategies, and so that might affect the weighting but not the return of certain assets in the portfolio. And volatility is often only reported on the downside, so we may need to see that in terms of the standard deviation because of things like that survivorship bias I mentioned earlier. Now, of course, for all of our investments, we like to be able to use the Sharpe ratio. And the Sharpe ratio does not work nearly as well for hedge funds as it does for a lot of our other investments. We all know how the Sharpe ratio works. Essentially, it's taking a look at the alpha divided by a measure of standard deviation. And it increases with time. The problem with the Sharpe ratio is it is only reliable if we have built in all of the qualifications of standard normal distribution. And hedge funds do not follow a standard normal distribution. There's asymmetry. In other words, we have skewness in the results because of optionality, and we have kurtosis. And so that's going to be a problem when we're actually taking a look at the Sharpe ratio, just in the constitution of the Sharpe ratio. Also, there's going to be an opportunity for hedge fund managers to be able to game the alpha and also the standard deviation by changing the measurement interval, by compounding the monthly returns and calculating standard deviation before compounding, and also through that optionality that will provide that skewness. So there are a lot of reasons why Sharpe ratio is still going to be applied, but we need to be able to interpret it with a little bit of careful judgment, a little bit of a grain of salt, we like to say. Now that's hedge funds. A different strategy which also equates to hedge funds, similar, but with a very different name and run by a different industry, is called managed futures. And essentially this is taking a look at the commodities that we looked at later and building a portfolio or an approach to investment around those commodities. We say they're about skillful trading of commodities, and that means that we're going to hire a professional who is well qualified and knows exactly how to manage those futures. The industry itself is probably around 30 years old. Essentially, it started with the definition of investors called commodity trading advisors, who operate within a regulated structure, certainly in the United States. They're a network of brokers, and they're regulated by the National Futures Association in the United States. So we have a specialist who may have particular experience in commodities, but even more likely things like financial futures, currency futures, and perhaps we have got commodity traders who are trading in physical commodities, but also those financial commodities as well. They tend to work with organized exchanges like Globex, and so they become essentially what used to be considered market makers within that industry. But their approach and their purpose is to manage a commodity portfolio for qualified investors. There are benchmarks, as there are with futures contracts, typically made up of managers, commodity trading advisors rather, who follow a particular approach. They essentially say these are the benchmark type of portfolios that you can or your firm can invest in. And we again have some problems with the data, because if a fund is wound down, if it's closed up, then that information will no longer be reported. So the ones that survive will provide the data, giving us a bit of skewed information, suggesting that returns are higher than they should be if we included both the failed as well as the surviving contributors. Some of the basic characteristics of futures. Futures, like most derivatives, are a zero-sum game. That means for every winner there's going to be a loser in equal proportion. And so it's not a type of investment which we expect to provide us with a standard normal rate of positive return. It provides us with a zero rate of return. So in order to provide investors investment opportunities in futures, we have to have other firms that are looking for hedging opportunities. And those who are going to participate, we expect, would have to be able to, or willing to pay a certain cost for doing that. As well as participating in a balanced market with equal trade, there may be opportunities through mispricing. In other words, extra information that you have allows you to systematically take advantage of low prices, buying cheap and selling high. One of the advantages as well with managed futures is it has a low correlation with bonds and stocks, and so gives us the diversification opportunity. For our portfolio then, it's useful to as a risk diversification strategy. The Sharpe ratios of portfolios that include managed futures tend to be a little bit better than those that don't. The benefits may accrue to particularly successful advisors, fund managers, and so there is actually a significant performance difference. Particular attention, I guess, should also be paid to strategies that take advantage of a little bit of extra knowledge and can leverage that knowledge by using additional debt within their strategies. So again, a very quick introduction to managed futures and the managed futures industry. A similar type of industry is politely called distressed securities, but it's quite often called vulture investing. And essentially this involves finding assets which are undervalued because they have a particularly bad reputation. If you have got real estate, a class of real estate that's doing very badly, it has a low price because people say bad things about it. Vulture investors come in, they buy low, they try to fix up whatever they can fix up, they unbundle the bad investments, they resell them, and they make a profit on that difference. Some examples of vulture investing or distressed security investing include hedge funds and private equity funds who specialize in that kind of an investment. For example, in about 2000, a group of my ex-students got together with an ex-guest speaker on one of my courses, and they'd all had experience in private equity, but they'd all lost their jobs because the industry had really contracted after the dot-com bubble. These folks met up in a coffee shop in London. My ex-guest speaker said, well, I've got some connections. I can probably find 50 or 60 million pounds to invest. You guys have all worked for different private equity firms. You know the best failing investments of your firm. Why don't we go and we'll buy these investments using the money that I raise in this new fund? We'll buy the investments at a very big discount on their net asset value, perhaps 10 cents on the dollar. And so that's essentially what they did. They put together a specialized fund to buy failed venture capital investments. They fixed up some of them, they combined some of them, they essentially sold the other ones off for parts. They probably took a $50 million investment and turned it into $60 million or $70 million simply by cleaning up the portfolio. It's the same way that a vulture cleans up a carcass. And so that was called vulture capital. And it turned out to be so successful that particular group eventually floated their business. They floated the vulture capital business on the London Stock Exchange and all got rich. The only sad part of that story is they didn't invite me to participate. Some of the types of assets that are part of vulture investing or distressed security investing: publicly traded debt, companies that are in financial distress and see their prices trading at very low level, with some possibility of either recovery or of realization after bankruptcy, providing some kind of positive return. Company that's sold off part of its business in the process of reorganization in an unbundling or an equity carve-out of the business. Bank debt can also be part of distressed investing. Lenders of last resort, especially for sovereigns, that might also be part of that investment. Countries that have defaulted on debt and seen the value of the debt written right down, that could also be part of this. And any kind of derivatives for hedging those related risks. Benchmarks are also, well, not specifically available for distressed securities, but they may be available through hedge fund and also private equity industry sources. The size of the yield on the investment isn't indicative because not all of the companies within those indices are distressed, and they tend to provide a relatively high Sharpe ratio because of high average returns and low standard deviation. There may also be a lot of skewness because of optionality, and also because a few funds may account for a large proportion of the returns, that extra kurtosis or the fat tail. So in other words, Sharpe ratio does not work well with distressed securities either. Some of the special characteristics of distressed security investments: well, your gain is somebody else's loss. Somebody's got a problem and they've got to dump some assets from their portfolio, then you have an opportunity to buy. For example, if a foundation like the Vancouver Island University Foundation had bonds that fell below BBB rating, they fell to a C rating, they would have to divest because of the conditions that are set in their own charter. So that means that they would put those up for sale, and not only would the price fall because of a falling credit quality, but they'd fall because of reduced marketability. And so low marketability stocks could become a buying opportunity. If a firm is in distress itself, it may sell assets, it may sell some of its accounts receivable in order to get quick cash. If a company has been planning to do a leverage buyout, raised a lot of debt using junk bonds, and then the leverage buyout falls apart, they still have the debt, and so that could also be an investment opportunity. Just about any opportunity can be created by somebody else's misfortune, and unfortunately that's where the vulture capitalists work. Typically it requires specialist skills. It's not about identifying good investments, it's about identifying good collateral quite often, seeing value that other people don't see. Just like being a junk dealer, really, isn't it? So some of the risk factors that are built into distressed security, well, there's a chance that the conditions that made the company weak in the first place may lead to complete failure, and that's something we can't have because that would write off the value completely. There could also be a problem with liquidity, and of course we're buying illiquid assets by definition, and so that's always going to be built in. When markets do better, when we see the economy picking up, a lot of those distressed securities become significantly more valuable. So it's partly going to be about the economy. There's also market risk. Bad things can happen in the market, interest rates, the state of the market. Those things tend to be less important than for a going concern. And another very unique factor is the possibility that a bankruptcy judge can provide an unexpected ruling, perhaps saying that even though we think that the company really is not a viable going concern, we're going to keep it operating for an extra 6 months because the employees need their jobs. Something we've seen happen on a fairly regular basis. Judges who are actually operating what appears to be outside the law. Some of the strategies that we have for distressed securities: investing directly in in distressed assets, long-only investing, and no short investments allowed. Distressed debt arbitrage, buying distressed bonds, and selling equity in order to create some kind of liquidity preference for the ultimate case of bankruptcy. And of course, private equity approaches that I've already described to gain influence over bankruptcy proceeding as a creditor, influence management decisions, and convert your positions to an equity state. In this session, we have taken a look at several different alternative strategies. We've seen that there are common threads. Finding benchmarks is difficult and not going to be quite so accurate. There is an opportunity to create a higher than expected rate of return, but we also see that quite often understanding, really having a deep understanding of the ways that those firms create value is a more complicated and interesting problem. In any case, we see that all of these alternative investments provide diversification opportunities, and they have a low correlation to the other investments in our portfolio. So while they're not going to be for everyone, they're definitely worth considering. I hope the session's been valuable. We've tried to summarize a lot of material, and I look forward to telling you a little bit more in class.